What if the reason you keep losing money in the market isn't because you chose the wrong investment, but because you arrived at the right one too late? It's a paradox most investors live with but never see. According to recent Vanguard research, the average retail investor underperforms the market by nearly 5% annually. Not because of bad stock selection, but because of bad timing. Buy at the peak, sell at the bottom, repeat. But here's the lie we've all been sold: that the market is random, chaotic, and unpredictable. That success is luck, and survival is prayer. The truth is more haunting and more empowering. The market is not chaos. It's a clock. A giant, invisible clock, ticking in cycles so vast and quiet that only the most perceptive can feel its rhythm. And those who do, they don't predict, they prepare. They don't chase, they wait. They don't follow the crowd, they move before it screams. This isn't about timing the market. It's about sensing it, about training your eye to spot what the herd ignores, about becoming someone who doesn't panic when everyone else does, because you already knew the storm was coming. In this journey, we'll uncover the hidden gears that drive every boom and bust. We'll decode the psychology behind mass euphoria and mass despair. And we'll walk through real stories of people who saw the signs and those who didn't, so that you never miss the hour again. Because once you start to see the market as a clock, you'll realize something powerful. You were never meant to be surprised. You were meant to be synced. Welcome to the invisible clock, where time isn't told by numbers, but by emotions, by cycles, by instincts trained to hear what others can't. You didn't notice it. No one ever does. The moment when the market's mood begins to shift, when euphoria flinches, just slightly, and confidence exhales a nervous breath. There's no alarm, no headline, no siren. Only a subtle click, like the quiet tick of a clock starting its motion. That's how 2008 began. Not with a crash, but with a calm. A dangerous calm. In early 2007, the world was drunk on housing wealth. People with no jobs were buying mansions with zero-down mortgages. The smartest guys in the room were designing derivatives so complex they could barely explain them. And the market? It kept rising. Because when the sun shines long enough, people forget what clouds are. But underneath, the gears were grinding. Quietly, relentlessly. The subprime rot had already begun. The first domino had already tilted. Yet most investors were still dancing. Still pouring money in. Still chasing returns that were already gone. Why? Because they didn't hear the clock. The clock starts ticking not when prices fall, but when questions are no longer asked. When the phrase, "you can't lose," becomes gospel. That's the signal. That's the first sound of change. And here's the brutal truth. You can't wait for confirmation. Because by the time confirmation arrives, the crowd has already panicked. The exits are already jammed. And you're already locked inside. The most important skill isn't prediction. It's perception. Being able to feel the shift before it becomes obvious. As Howard Marx often said, you can't predict. You can only prepare. It begins as excitement. Then it becomes obsession. And finally, addiction. Greed doesn't feel evil when it arrives. It feels smart, rational, deserved. Like you've finally cracked the code and are about to collect what the world owes you. Think back to early 2021. A 19-year-old on Reddit posts about GameStop, and suddenly the world thinks Wall Street is being defeated by memes. Robinhood accounts explode. Everyone's a genius. Stocks don't just go up, they only go up. And the deeper you go into the euphoria, the more the market becomes less like an investment, and more like a religion. The belief? That this time, gravity is broken. That risk is a myth. That you're just one trade away from changing your life. But behind the scenes, the clock is accelerating. Greed turns the gears faster and faster, until they grind themselves into dust. Because greed doesn't just blind you. It speeds you up. It removes all brakes. You stop analyzing and start chasing. You stop questioning and start believing. And worst of all, you stop planning. This is the exact moment when the invisible clock traps the crowd. Everyone runs in the same direction, towards the same stocks, the same coins, the same hype, like moths to a flame, racing to be early but destined to be late. The cruel twist. When the top arrives, nobody wants to believe it. The peak of the cycle never feels like the peak. It feels like the beginning of forever. There's a moment in every cycle where the market feels perfect. Volatility drops. Headlines glow. Analysts smile. Your portfolio ticks upward with robotic precision. No drama, no doubts, no fear, It feels like the safest time to invest. But this feeling, this serenity, is the final trick of the invisible clock. The illusion of safety doesn't appear when danger is gone. It appears right before danger returns. Consider late 2006. The housing market was booming. Foreclosures were historically low. Banks were flush. People said things like, real estate never goes down, and believed it. But beneath the surface, the gears of debt were tightening. Derivatives stacked on top of other derivatives. Credit default swaps whispered risks that nobody listened to. Everything felt safe, until one domino fell, and the rest followed like a whisper turned into a roar. The trap. The most dangerous point in the cycle isn't the crash, it's the calm before it, because that's when everyone lets their guard down. That's when leverage grows. That's when risk gets repackaged as stability. It's one thing to spot danger when no one else does. It's another to act on it while the world mocks you. Being a contrarian isn't glamorous, it's lonely. And that loneliness is the price of being early. Imagine standing in a crowd that's cheering, clapping, celebrating. The music's loud, the lights are blinding, and the punch bowl is still full. But in the corner of your eye, you see the first crack on the dance floor, a tremble in the ground, a slight flicker in the lights. You whisper, "We should go." But no one listens, because the party's still going. In 1999, Howard Marx sent out one of his most famous memos, warning that tech stocks were priced for perfection. He didn't scream. He didn't panic. He simply laid out the truth. Expectations had lost contact with reality. But for over a year, the market kept rising. .com stocks soared. Pets.com had its IPO and doubled. The party refused to, and Howard Marx looked like a fool until he didn't. The paradox. Being early feels wrong until it's suddenly right. The market punishes truth-tellers with time delays. You might be right, but if you're early, you're still wrong in everyone else's eyes. This is where most investors break. Not during the crash, but during the silence before it. When their gut says, get out, but their ego says, don't look stupid. When their research says, danger, but their feed says, to the moon. The contrarian's burden. You don't need to be first. You just need to be early enough to prepare and late enough to not look insane. The human brain was not built for markets. It was built for survival. And in the wild, your odds of staying alive were always better when you moved with the herd. If everyone ran, you ran. If everyone ate from the same bush, you followed. Those who strayed too far often didn't return. But what protected us on the savannah destroys us in the stock market. Because here, following the herd doesn't keep you safe. It makes you a target. When the crowd rushes in, prices soar. Not because of value, but because of volume. More buyers mean more demand. More demand pushes prices up. Rising prices attract attention. Attention becomes hype. And suddenly, no one's asking if the asset is good. They're just scared to miss out. The trap. By the time you hear about the next big thing, it's already been bought. Not by you, but by the quiet hands that were there before the herd arrived. The real money doesn't scream. It whispers, acts early, and leaves without noise. What stays behind is the crowd and the crash. Let's go back to 2021. Crypto, tech, meme stocks. For a few dazzling months, everyone became a trader. College kids, retirees, Uber drivers. Social media became a trading floor, but it wasn't analysis, it was imitation. Screenshots of gains, rocket emojis, diamond hands. The illusion of success, but when the tide turned, it turned fast. Terra collapsed. Tech stocks halved. Robinhood accounts bled, and the herd trampled each other trying to get out. The same crowd that cheered you in disappears when it all falls. The market doesn't forget. It remembers in patterns, not in perfect repetition, but in rhyme. Every boom has its echo, every crash its ghost. The names change, .com, housing, crypto, but the rhythm is the same. Hope swells, greed blinds, fear explodes, and silence follows. Then, the invisible clock doesn't tick in seconds. It ticks in sentiment. In 2000, tech stocks soared on promises of a digital revolution. Valuations were absurd. Profits didn't matter. The story did. Companies with no revenue were worth billions because they had a vision. Sound familiar? Fast forward to 2021. AI, NFTs, the metaverse. Hype beat fundamentals. The market had forgotten, but only on the surface. Underneath, it was repeating itself. Because cycles aren't just about prices, they're about psychology, and the collective human mind doesn't evolve as fast as we think. If you want to see ahead, don't look forward. Look backward. Study the emotions, not just the economics. Because humans repeat emotions long before they repeat logic. There's a story from 2007, just before the housing collapse. A hedge fund manager wrote in his letter, "This time is different. The credit market has evolved." But the tools weren't different, just the packaging. Risk was still risk, but dressed up in complex language. And those who studied the past, who remembered what excessive leverage looked like, got out early. Because when you've seen the cycle once, you can feel its return. Like a weathered sailor who smells the shift in wind before the clouds appear. It doesn't scream, it doesn't flash, it doesn't trend on Twitter or make headlines. Value whispers, quietly, calmly, almost too softly to notice. But if you've trained yourself to listen, if you've tuned your instincts to the deeper rhythm beneath price, you'll hear it. And when you do, you'll discover something radical in a world addicted to speed. The best opportunities come when no one's looking. Warren Buffett once said, "The market is a voting machine in the short term, but a weighing machine in the long term." That's what value investing is. Not chasing popularity, but measuring substance. And substance doesn't trend. In euphoric markets, fundamentals become background noise. A company loses money every year? Doesn't matter. It's growing. A token has no use case? Who cares? It's up 300%. But while the crowd yells, the whisper of value remains constant. It doesn't change with hype. It waits, and rewards those who wait with it. Let's revisit the chaos of 2009. The world was on fire. Lehman had collapsed, banks were teetering, everyone was dumping stocks, terrified the system would collapse. But underneath the panic, something rare appeared. Quality companies trading at massive discounts. McDonald's, Johnson & Johnson, Microsoft. Real businesses, real profit. And for those who had the clarity and the courage to listen to the whisper, fortunes were made. Not because they predicted recovery, but because they saw value when no one else could. The invisible gift of cycles. During fear, prices fall below intrinsic worth. And during greed, they soar far above it. Your job is not to guess the top or bottom. It's to recognize when value has been forgotten and act while it's still quiet. It never feels like the top. That's the final trick. At the peak of every cycle, when valuations are stretched, when logic is abandoned, when smart voices are silenced by the thunder of profits, it doesn't feel like madness. It feels like genius, like clarity, like destiny finally rewarding the faithful. That's why most people don't crash when the market falls. They crash because they never saw it coming. In 2007, real estate agents were quitting their jobs to flip houses full-time. In 1999, taxi drivers were giving stock tips on fiber optic companies they barely understood. In 2021, influencers with zero financial background were launching coins, pumping stocks, and claiming to have unlocked the secrets of wealth. It all felt normal, brilliant even, because when you're standing at the top of the mountain, the world looks infinite. But the air is thinner up there, and gravity never sleeps. Howard Marx calls this euphoria, the final phase before the fall. It's a moment where everyone believes they're smarter than the system. That risk has been neutralized. That this time is different. But it never is. Because cycles don't break, they bend. And the more violently they stretch, the harder they snap. The invisible clock doesn't ring a bell at midnight. It lets you dance a little longer, right to the edge. The market is loud. Charts flash, news breaks, opinions flood in like water through a broken dam. Everyone's analyzing, reacting, shouting. But buried in all that chaos, beneath the blinking candles and hot takes, is a signal. Subtle, consistent, often ignored, but the investors who thrive in cycles are not the ones who react fastest. They're the ones who can hear that signal through the noise. Howard Marks doesn't make his moves based on breaking news or sudden market moves. He reads mood, sentiment, positioning. He listens not to what people say, but how many are saying it. That's the first clue. When everyone agrees, the signal weakens. When the market becomes a choir singing the same song, that harmony is often the sound of complacency. Back in early 2020, right before the pandemic crash, everything looked stable. Economic indicators were strong, unemployment low, tech boom. But credit markets, quiet, overlooked credit markets, started to tighten. That was the signal, and a few noticed. Not by watching headlines, but by tracking the pressure building beneath them. They saw the clock slowing, the gears grinding, the market's heartbeat skipping just slightly. Then the crash came, and for most it felt sudden, but for those who had trained their ears, it had already begun. So what does the signal sound like today? The signal lives in the extremes. Investor positioning is crowded in fewer and fewer names. Retail leverage has quietly climbed back to dangerous levels. And most damning, volatility is low not because risk is gone, but because fear is anesthetized. The market isn't calm, it's sedated, and when it wakes up, it doesn't yawn, it screams. The real question, can you hear it? Can you separate information from insight? Because not all data is useful, and not all noise is worthless. You need to train your perception. Learn which indicators matter for you. Whether it's volatility spikes, credit spreads, insider selling, or volume anomalies, every signal has a cycle, and every investor must. The goal isn't to predict exactly when something will happen. It's to recognize when the tide is shifting and start adjusting while everyone else still thinks the water is warm. In the symphony of market cycles, the most powerful instrument is silence. Not analysis, not prediction, not even action. Just the ability to wait, to stand still while others run in circles, to remain calm while the crowd screams. In a world obsessed with doing, patience feels like weakness. But in investing, it's the ultimate strength. Because cycles don't reward activity, they reward timing. And the space between opportunity and disaster is often a matter of stillness. Think about Warren Buffett in the late 1990s. The dot-com boom was raging. Tech stocks were minting millionaires. And Buffett? He sat on the sidelines. Mocked. Called outdated. But he waited. And when the bubble burst, he stepped in while the ashes were still warm, and bought value at discounts that others couldn't even see. That's patience in motion, the discipline to watch others win short-term battles while quietly preparing to win the long-term war. Howard Marks once wrote, "Being too far ahead of your time is indistinguishable from being wrong." That's the burden of patience. You'll look foolish. You'll feel the itch to jump in. You'll doubt yourself. Because we're hardwired to crave movement. When your portfolio is flat, your instinct is to fix it. When everyone else is celebrating gains, you feel left behind. But cycles are not won by constant motion. They are navigated through rhythm, knowing when to step and when to stand still. Patience is not laziness, it's precision. It's the quiet confidence that comes from understanding the clock and knowing that not every tick requires a reaction. There are moments in the market when doing nothing is the most aggressive move you can make, like the deep inhale before a strike, the archer's pause before the release. Crashes don't come out of nowhere. They build in silence. They gather like clouds behind the blue sky, invisible to those dancing in the sun. Then suddenly, lightning. But if you look back at every major financial crisis from 1929 to 2008 to 2020, you'll see the same thing, a pattern, a rhythm, a clockwork so precise it's almost poetic. Let's rewind to 1929, the Roaring Twenties, jazz, innovation, exuberance. Stock prices rose with wild abandon. The belief was simple: the future would never look like the past. But it did. And when the clock struck, fortunes evaporated in a blink. Now fast forward to 2008. The language changed: CDOs, subprime, securitization, but the behavior didn't. And again, the fall. Even 2020, though triggered by a pandemic, was not a complete surprise to those watching the underlying stress. Corporate debt had ballooned. Valuations were stretched. One external shock was all it took to expose the market's fragility. The invisible clock had been ticking. What felt like a sudden blow was, in fact, a long overdue correction. Howard Marx teaches that cycles are not chaotic. They're inevitable. What feels like randomness is often just our ignorance of timing. And when we fail to recognize how far we've moved into excess, we confuse a natural reversal for catastrophe. But here's the deeper truth. Crises are the cleansing agents of the market. They reset expectations. They expose fraud. They transfer wealth from the unprepared to the patient. They're brutal, but necessary. So why do we still get caught in them? Because recognizing a crisis before it happens requires letting go of optimism at its peak. And few want to do that. It's uncomfortable to step aside while others still dance. But it's essential. There is a moment in every cycle when the storm has passed but the sun hasn't returned. The crash is over, but the boom hasn't begun. It's quiet, still, boring. This is the in-between. And in the world of investing, it's where the majority check out, mentally, but this forgotten stretch of time is where the few build their empires, quietly, patiently, without applause. After 2008, many investors stayed on the sidelines for years, scarred, skeptical. They waited for a signal that everything was, but while they waited, the market was already rising, slowly, unevenly, but consistently. The time between fear and greed was rebuilding value. And those who stepped in, not with excitement but with clarity, made fortunes, not overnight, but over time. This middle phase, the plateau between extremes, is where the invisible clock slows down. The ticking isn't urgent. There's no crisis to react to, no hype to chase, just fundamentals. It feels like nothing is happening, but everything is happening beneath the surface. Companies reposition, debt gets reduced, risk premiums normalize, and smart capital finds its way to neglected corners of the market. But here's the catch. This period feels unrewarding. No fireworks, no headlines, just a steady grind. And that's why most investors either lose interest or force action. They chase excitement elsewhere. They believe boredom means stagnation. But the truth is, this is the time when you have the most clarity. With fewer distractions, you can research deeply, plan patiently, position intelligently, and the market, like a pendulum, slowly begins to build momentum again. Defense is not retreat. It's choreography, a dance between caution and courage, between protection and participation. The myth of investing is that success comes from bold, aggressive moves. But the truth? The truth is quieter. It lies in the subtle art of knowing how much to risk, when, and why. Defense isn't weakness, it's wisdom. Think of the best investors, not just the richest, but the ones who've survived decades. They're not always swinging for the fences. They're managing exposure, sizing positions, holding cash, hedging without obsession. Howard Marx once said that avoiding losses is the most important thing. Because if you lose 50%, you need a 100% gain to get back. That's not just math. That's psychological trauma. And it's avoidable. Take the example of Seth Klarman. His hedge fund, Baupost, is known for often sitting on large amounts of cash. During euphoric markets, that cash looks lazy. But when corrections come, it turns into firepower. Klarman doesn't just buy when others panic. He waits until there's value with a margin of safety, and he sizes his bets to survive the storm, not just chase the sunshine. That's defensive brilliance. That's the dance. The problem is, modern investors are taught that sitting out is missing out, that if you're not all in, you're falling behind. But that's not strategy. That's FOMO in a suit. Real defense is knowing how to participate without surrendering control. It's rebalancing when things get stretched. It's trimming winners when they defy gravity. It's using stop losses not out of fear, but out of respect for the clock. And here's the most powerful shift. Defense doesn't mean missing out. It means staying in the game long enough to capture the biggest upside when it actually makes sense. The future is a mystery wrapped in the fog of uncertainty. Every day, experts, analysts, and self-proclaimed gurus flood the airwaves with predictions. Bullish calls, bearish warnings, economic forecasts, each more confident than the last. But here's the irony. Markets don't care about certainty. They move on probabilities, emotions, and surprises. Think of the most iconic forecasts in recent history. In 2007, almost everyone believed housing prices would never fall nationally. In 1999, most thought the tech boom, and in early 2020, few anticipated the pandemic's economic devastation. The problem isn't that forecasts are wrong, they often are. The problem is that so many investors believe in forecasts as if they were facts. They anchor their decisions on what experts say, ignoring that the market is a complex system influenced by millions of unpredictable variables. Howard Marx cautioned that you can't predict, you can only prepare. But preparation requires humility, the ability to acknowledge. It means understanding that no model or prediction can capture the full scope of market dynamics. The fog isn't a barrier to success. It's a reality you must embrace. The best investors aren't clairvoyant, they're adaptable. They build portfolios designed to survive multiple outcomes. They expect surprises. They balance optimism with. So, how do you navigate the fog? By focusing on what you can control, your risk tolerance, your position sizes, your margin of safety. By watching the clock's rhythm, recognizing when euphoria or fear is driving prices beyond reason. By not being swayed by the endless noise of forecasts. Because the market's future is not a fixed path, it's a dance of probabilities. Your mind and the market are mirrors of each other, both swinging between extremes. When the market is euphoric, your brain floods with dopamine, fueling confidence and risk-taking. When fear grips the market, adrenaline spikes, tightening your grip on cash and safety. This emotional pendulum is as much inside you as it is in the ticker tapes and price charts. The invisible clock doesn't just tell time on the calendar, it ticks in the rhythm of human psychology. Daniel Kahneman's groundbreaking research showed that humans are predictably irrational. We overreact to gains, underreact to losses, and often let emotions guide decisions. That's why markets cycle. It's why bubbles inflate and bursts follow. Because the crowd is a collection of individuals whose feelings swing like a pendulum, pushing prices up and down far beyond intrinsic value. Imagine a room full of investors. When optimism spreads, they cheer, buying enthusiastically. When pessimism arrives, they panic. No wonder prices fluctuate wildly. The challenge for you, the thoughtful investor, is to recognize when your own mind is caught in this swing. Are you riding the high of recent gains, feeling invincible? Or are you frozen in fear after a loss? Awareness of your mental state is the first step to breaking free. Howard Marx wrote extensively about this psychology of cycles. The key is not to fight your emotions, but to understand their patterns and let the pendulum guide you wisely. When fear is at its peak, opportunity often knocks. When greed reigns supreme, caution becomes your shield. The market's invisible clock is powered by collective emotion. And by mastering your own psychological pendulum, You tune yourself into the clock's true rhythm. Ignorance in investing isn't just a lack of knowledge. It's the failure to understand your place in the cycle. Many investors suffer not because they pick bad stocks, but because they don't recognize where the market clock is pointing. The price of this ignorance? Often devastating losses that could have been avoided with just a little awareness. Imagine a retiree who pours their savings into the market at its peak, blinded by last year's gains and the crowd's excitement. When the crash arrives, they lose 40% of their nest egg overnight. That loss isn't just financial, it's emotional. Trust is broken, dreams deferred. They ask themselves, how did I not see this coming? The harsh answer is, they did, if only they had listened to the clock. Howard Marx often emphasizes that understanding cycles is a form of wisdom that far outweighs complex models or technical analysis. It's about humility, recognizing that no one knows the future with certainty, but everyone knows the patterns of the past. Ignorance is not innocence. It's a choice to ignore what history and psychology teach us. The invisible clock is relentless but fair. It punishes those who ignore its ticks and rewards those who heed them. Every cycle offers lessons: the exuberance of the top, the panic of the bottom, the patient rebuilding in between. But if you fail to place yourself on that timeline, you're wandering blindfolded into danger. The true cost of ignorance isn't just losing money, it's losing time. And in markets, time is your most valuable asset. The peak of the market is the most elusive moment of all. It never announces itself with flashing signs or urgent warnings. Instead, it hides behind optimism, behind confidence, behind stories of new paradigms and secular growth. The peak feels like the beginning of something greater, not the end of everything. That's why it's called the hidden peak, the moment when the market is at its most dangerous precisely because no one realizes it. Look back at the dot-com bubble. At its height, companies with no profits were worth billions. The media celebrated the new economy. Investors believed technology had forever, but behind the scenes, the clock was ticking toward reckoning. It just wasn't loud enough to be heard. Similarly, in 2021, when cryptocurrencies reached dizzying heights, few wanted to admit the possibility of a crash. The dream was too powerful, the fear too weak. Howard Marx teaches that recognizing the peak is less about finding certainty and more about noticing the absence of it. When everyone agrees on endless upside, the clock is close to striking. When risk premiums vanish and valuations soar beyond historical norms, you're nearing the top, even if it doesn't feel like it. The tragedy of the hidden peak is that it catches most investors unprepared. They stay invested because the market keeps rising, believing it will continue indefinitely. They ignore warnings, convinced they're different, smarter, or luckier. But when the music stops, the fall is swift and unforgiving. The best investors don't try to time the exact top. They build their defense as they climb, ready to step aside when the signs become clearer. How do you spot the hidden peak when it's designed to be invisible? By focusing on fundamentals, by questioning consensus, by respecting history, and by listening to the subtle ticks of the invisible clock. Because sometimes the smartest move isn't riding the wave, it's knowing when to paddle back. In a world obsessed with speed and instant gratification, the market rewards the patient, the steady, and the slow. The loudest traders scream for action every second, chasing every headline and tweet. But the most successful investors, those who survive multiple cycles, practice the strategy of slow. It's not flashy, it's not glamorous, but it's powerful beyond measure. Consider the tortoise and the hare. The hare races ahead, fueled by bursts of energy and confidence, only to tire and stumble. The tortoise moves deliberately, consistently, without distraction, and wins the race. Investing is no different. The market's invisible clock favors those who pace themselves, who resist the urge to chase short-term gains and instead focus on sustainable growth. Howard Marks embodies this strategy. His memos emphasize second-level thinking, going beyond the obvious, acting when others hesitate, waiting for the right opportunity rather than the next big thing. This slow approach means you miss some rallies, but you avoid the brutal crashes. It means building wealth quietly, steadily, invisibly, while others spin in cycles of hype and despair. Slow is about discipline. It's about saying no when everyone says yes. It's about sitting on cash or holding positions patiently. It's about understanding that the market is a marathon, not a sprint. And it's about the humility to accept that you won't always be right, but that over time, consistency beats intensity. The strategy of slow asks you to resist the urge to trade constantly, to fix what isn't broken, to trust the invisible clock even when it moves quietly. Because the loudest moments are fleeting, but the steady beat of time endures. Numbers don't lie, but they don't always tell the whole truth either. In today's age, data floods every corner of investing, promising clarity and certainty. But beneath that surface of charts, ratios, and statistics lies a subtle deception. The temptation to trust numbers without context, to believe patterns without understanding, to find the market's invisible clock isn't just about numbers ticking upward or downward. It's about the story those numbers tell, and more importantly, the story they don't. A company might show stellar earnings this quarter, but what about debt levels, cash flow, customer retention? A bubble might inflate as price-to-earnings ratios skyrocket, but are those earnings data divorced from insight is like a clock without hands, meaningless. Consider the 2000 dot-com bubble. Price-to-earnings ratios were astronomical, but many investors ignored or the 2008 crisis, when complex financial instruments were misunderstood because people trusted the models without questioning assumptions. Today, with AI-powered analytics and algorithmic trading, data's volume has exploded, but so has the risk of misinterpretation. Howard Marks stresses second-level thinking, which requires digging beyond the numbers. It's asking, what are others missing? What risks lurk beneath the surface? How does this data fit into the broader cycle? Because numbers are just part of the invisible clock's rhythm, the real challenge is understanding the why behind the tick. Mastering the clock means not just collecting data, but interpreting it with wisdom, skepticism, and perspective. Howard Marks is more than an investor. He's a master timekeeper. His memos don't predict, they perceive. They don't scream, they whisper. Behind every insight lies decades of watching the invisible clock, feeling its subtle ticks and turns. What sets Marx apart isn't magical foresight, it's humility, discipline, and the relentless pursuit of understanding cycles in all their complexity. Imagine a craftsman, patiently tuning a clock's gears, knowing each adjustment impacts the whole. Marx approaches investing the same way, carefully calibrating risk, observing sentiment, and positioning his portfolio to survive storms others don't see coming. His famous memos aren't just letters, they're lessons in patience, skepticism, and emotional control. He reminds us that markets are neither perfectly efficient nor entirely random. They're human, and humans have predictable patterns. His strategy is not to outrun the clock, but to dance with it, moving with rhythm rather than against it. By respecting cycles, he gains an edge not by guessing, but by preparing. Marx offers clarity through simplicity. Understand risk, beware of extremes, and never forget that the market's invisible clock is always ticking, even when you think it's silent. Mastery is not about certainty. It's about embracing uncertainty with wisdom. It's about listening deeply to the clock's rhythm, adjusting your steps, and moving forward with confidence born from understanding, not hope. The final hour in every cycle is a crucible, a test of everything you've learned, felt, and practiced. It's the moment when the invisible clock's ticking grows loudest, when decisions must be made with clarity and courage. Do you act? Do you wait? Do you retreat? This hour separates the timekeepers from the timekeepers in training. When euphoria peaks, Many double down, convinced the ride will never end. When fear crashes down, some flee in panic, losing more than money, their confidence, their composure, their future. But the masters know. Timing is not an exact science. It's a balance of signals, emotions, and instincts honed over years. It's the art of navigating the unpredictable with discipline and humility. Howard Marx teaches that no one can perfectly time the market, but everyone can recognize when it's time to adjust. That means raising cash, trimming risk, or stepping boldly into opportunity, but always with a margin of safety. It means listening to the clock, not the crowd. Trusting your trained instincts over the noise. So, in this final hour, ask yourself, have you prepared for the unexpected? Do you have the patience to wait, the courage to act, and the wisdom to know the difference? Because the invisible clock doesn't just tell time, it reveals character. It rewards those who keep pace, who respect its rhythm, who move with grace amid chaos. As the cycle turns, remember, success isn't about predicting midnight. It's about dancing through the hours, attuned to every tick and talk, ready for what comes next. This is your moment. The clock is ticking. Will you hear it? You've journeyed through the hidden rhythms of the invisible clock, unveiling the cycles, the emotions, and the wisdom that guide markets beyond noise and chaos. You've learned how timing is less about prediction and more about perception, how patience outlasts panic, how value whispers when the crowd shouts, and how mastering your own psychology aligns you with the market's eternal rhythm. Now it's your turn. Where do you think we stand on the clock today? Are you dancing with the herd or moving ahead of it? Share your thoughts in the comments. Let's build a community that listens deeply, acts wisely, and survives together. Remember, the greatest investors aren't those who know the future. They're those who respect the present moment, who feel the tick before the toll, and who navigate the invisible clock with clarity and calm. Subscribe, join the conversation, and keep your timing sharp. Because in markets, as in life, the best moves come from listening. And always remember, you don't have to predict the market to master it. You just have to hear its clock. The invisible clock, where time isn't told by numbers, but by emotions, by cycles, by instincts trained to hear what others can't.